Okay, welcome everyone. We'll start our lesson in 2 minutes. We'll just do a bit recap what we learned in the previous lesson, and then we'll start our lesson today. So a couple of you know me. My name is Anjum Satha. Please, if you have any question, drop me email anjum@ukeversity.co.uk and I'll try my best to get back to you as soon as possible. So today's lesson is we'll go through LO4, which is be able to interpret financial statement and make justified recommendation. We already discussed the aim of this unit really to develop understanding. So until today, what we discussed in LOs, let's we do a bit recap. We discussed about accounting standards, IAS International 1, 2, 7, 16, 19. We discussed 36, 37, and 38 accounting standards. We discussed IFRS 3, financial reporting standards 3 about business combination. We discuss about consolidated financial. We discuss about consolidated. So we discuss parent, subsidiary. We had a discussion about parent, subsidiary, and associate. We had a discussion about stakeholders. We discussed about qualitative 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 Hello, good afternoon. Hello, good afternoon. Okay, thanks for joining. Good afternoon. Okay, so we had until now we discussed about accounting standard IAS 1, 2, 7, 10, 16, 19, 36, 37, and 38. So preparation, presentation, inventory, cash flows, events, depreciation, revenue. We discussed about goodwill, non-current assets, impairment, losses, all we had in the previous lesson. So we had a discussion about qualitative characteristic, qualitative characteristic of financial statements. So those we discussed, year-end adjustment. And we had a discussion on depreciation, and that was the key in the previous lesson. So today lesson really will focus our LO4, which is about able to interpret, the key interpretation will go through the financial ratios and why these financial ratios are important, and looking in terms of the general acceptable accounting principle, IFRS 105 and 102. That will be in our discussion. Financial ratio is measuring the relationship between two numbers, and financial ratios is very important to measure the performance of the company. So always good to be, we have 2 years ratios to measure the performance, because if you have only 1 year ratios, it's difficult to compare the performance. So that's why it's quite crucial, which we need to be look around. That's we need to look around in the financial ratio. So ratios are the simple calculation based on the interaction set of data. For example, the change in the cost of the sale directly linked with the change in the sale activities and so on. So ratios of these interactions of the symbol and concise format, and we can look around the limitation of these ratios as well. So how many types of these ratios, how we can categorize these ratios, and interpretation of the ratios are very important. So first of all, liquidity. When we say liquid, it means the current asset divided by current liability. So current asset mean like inventory, trade receivable, cash, prepaid, debtors. So these are, we can convert them into cash quickly. These are called liquid. Okay, so then we have within that current ratio divided by current asset. Then we have a quick ratio, because sometimes inventory is not a most liquid and we want most liquid. So current asset minus inventory divided by current liability. So there is a benchmark 2 to 1 for our current ratios, 1 to 1, which is means £1 worth of asset, £1 worth of liability. So we can look around these. Then we have a financial position ratios are also known as gearing ratio, interest cover ratios, profit from operation divided finance cost, gearing ratios. We can look around like a drive in a high gear, high risk, so we can look around. If you have the gearing ratios increase, so which indicate that the risk of the companies is increasing with the passage of time. So we have to look around these, because ultimately we need to be make sure we minimize the risk, maximize the opportunities, because otherwise, the risk can huge impact the profitability of the company. So we have to be look around the risk and profitability of the ratio. Those we need to be in line. Okay, so that's we look, then we'll go through the profitability and use of resources, also known as efficiency. So return on capital employed ratios, we can look around profit from operation, total equity plus non-current liabilities. So because the non-current liability, we borrow money for the long term to buy high value assets. Return on capital asset, return on equities, profit, gross profit, which we'll use, gross profit divided by revenue and times by 100. We can look around the expense to the percentage of the sales of the revenue, we call operating profit margin. We can calculate inventory turnover days, how many days inventory being turnover into the finished goods. And then we are, so inventory cycle, we can look around in 28 days. A working capital cycle, we can calculate through these three ratio. Trade receivable in days, how many days? So always trade receivable days should be shorter than the trade payable days. You're receiving money in 30 days, you're paying your supplier in 90 days, so 60 days you have a benchmark. You always have a cash, that is quite crucial for the sustainability of the business, because otherwise we can be without the cash. Yes, so we don't want to be that thing happen without the cash. So we can look around the receivable, trade payable divided by the cash cost of the sales, because the cost of the sales is linked with the purchases you do on the credit, is linked with the creditors, and those, we can look around the payable in days. That can be 90 days, but if it's a lot, then industry average that can be Inventory days plus receivable days minus payable days is to represent the working capital cycle, asset turnover, revenue divided by total asset. We can look around the asset turnover in net assets. So we can look around the revenue divided by total asset minus current liabilities. So how many times, how much percentage, which we can look around if we turnover. So these are all the ratios. Then of course ratios we measure, not measure the like supermarket ratio with the small, looking in the same industry with the same size of the company and each ratio we do interpretation of the ratio, current year, the previous years, industry averages, and then we can make the decision which company is perform well, which years is perform well, why is perform well, and we sometimes maybe the ratio really look good, but we need to be think about some ratio really indicates the ratio is good, but actually what's happening current environment. So you have to look around political, economic, social, and technological factor, micro environment as well, very important. Because the reason ratios look good, but ultimately this can be huge impact. So return on equity, we can look around the profit percentage of the expense ratio. Okay, so we can look around the expense revenue percentage. We can look around the asset turnover, revenue, asset minus current liabilities. We can look around these. It's very crucial if we have to. Current ratio divided by current asset divided by current liability, and quick ratio current asset minus inventory divided by current liabilities. Cost of sales, inventory holding period. We can look around inventory versus the cost of sales, trade receivable, collection period, and payable. So these, the ratios, financial position, gearing ratio, which we mentioned, interest cover ratios, we can look around. So let's, we have two companies here in this our example, which we can look around. We have gross profit percentage divided by revenue times by 100, so we can convert it. So Anika and Anika's is 45% and Papika is 52%. Operating profit ratios 9 and 11. Gearing ratios 13.26. Debt divided by debt plus equity and 71. So 71%. So high risk company is the Papika. Alternative gearing debt to equity, these are two ratios formulas we use, 15 point and 245. Interest cover ratios 11.6 times and 3.1 times. Their profit is higher than the interest, which is the finance cost. Asset test ratios, current asset divided by inventory, and 1.22, and we can look around 0.66. So these are the ratios really we need to be look around and to measure the performance of the company. So what do you think, please? What do you think? We'll go for Anika or we'll go for Papika to invest? If we look the gross profit, Papika is a better. Operating profit, Papika is a better. When we look the gearing, Anika is a better because Anika's is 13% risk and 71% risk, the factor high gear, high risk. So that's we can, when we look the interest cover ratios is 11.6 times, profit is a higher, 3.1 is a high risky is Papika, and asset test ratios, which is mean current ratios, 1.22 is 1, and this is 0. So every 65 pence of asset, 1 pound worth of liability. So we can look around these, that's a huge, impact. And according to overall, we can suggest, Anika is the best company for investment. We go for Anika instead of Papika. So the company performance may be compared with the previous period, maybe just the effect of the price changes. Maybe we can look around the currency fluctuation, try to be overcome the problem of the vertical analysis, commonly compare the performance for the particular period, yardstick comparison, size of the company, separate industries, and we look, the performance well. Okay, so this type of the analysis compare the company result ratios. We can look around the schemes like, context analysis, which we can look around the needs to be kept in mind. we can, and the financials, and we can look around your company results compare. So the ratios show the particular weakness of the company, how the business is planned well, these need, they turn the businesses, impact on the decision, and the strategies can be so like tradable, pay days, trade payable days, inventory turnover days. Overall, we can say the working capital cycle. Okay, so various stakeholders interested in various ratios. We can look around the users of financial statements. So we can look around like, the investors, potential investors, lenders, suppliers, other trade creditors, customers, government, their agencies, and public. So that's are very important. They are different interests they have. The investor they want to be measure the performance because they want to be measure that the company is a potentially and they're paying the dividend and the return on their investment. Future investor can decide to invest. Lender can decide, either to lend on what rate, because based on the credit scoring and the ratios. Customer want to be if the guarantees and warranty company is giving how strong, how long, and whole the company, and the public really want to be contribution toward entity in the local economy. So these are different stakeholders. They have, or we call them user. So when we look the decision here, let's we look, please, the gross profit is a better topic, operating profit is better topic, Anika is less risky, Anika is less risky, Anika is better, is and less risky company. So overall, based on all these are ratios, we can say Anika's performance is better than Papika's. And we can look around these, in the light of performance, and that's which we can look around and the performance is the better. Okay, so please for further we can interpretation of these ratios, we can look around in terms of if you want to work towards the merit criteria, financial reporting affect the interpretation of the report. We can look around the gap general acceptable principle. We can look around different legislations. These also impact on the business performance, like creative accountant always try to be look the figures very healthy for the company. They can influence on the decision. So we have to look around the lot of the corporate governance, future plan of the company in terms of how the future the company, their profitability and their. So these all factors we need to be look around before we decide to go ahead, and make the decision to invest or not invest on the certain company. So that's really, really matters. We need to be look around the performance and draw the conclusion accordingly. Okay, so that's we need to be with the manipulation of the financial statement, committed fraud against the invested regulation and real and ongoing problems. We can look around the managers may also put the books, in order to qualify the certain executive compensation and rely on the certain financial performance metrics because of the general acceptable accounting standards we need to be. We have the Enron, their share was trading on $300 a share, and in the narrow span, which is drop, the shares from 300 to 60, 85 cent a share, and because the future business and they cook the book, so we can look around these are all so we can't 100% realize maybe before COVID-19 the ratios look, but COVID-19 happened, the restriction and the profitability is a huge impact. So we have to look around the impact on these, on the ratios due to these issues. So we can look around Enron scandal, which is quite, and the more than 74 billion shares worth of the shareholders lost, the main players, Jeff and Skilling and all, so those we need to be look around. So we can look around quickly. I can show you the quick video, the Enron scandal. So we can look around that. Okay, so quickly we can.
Wow, I just built the most amazing workflow on Monday.com. You build your own workflow? Why? There are a bunch of them.
At the start of 2001, Enron was the blueprint for large corporations, boasting 30,000 employees and an annual revenue of $100 billion. But by the end of the year, the company had garnered the title of biggest bankruptcy of all time, while Arthur Andersen, one of the Big Five, suffered a similar fate for their part in the scandal. So how did the energy giant, once valued at $70 billion, go from winning Fortune's most innovative company for 6 years in a row to bankrupt in the space of just a few months? Here's a story of fraud, corruption, and serious mismanagement. Here's how it happened. For some background, Enron was founded as a result of a merger between energy firm Internorth and utility company Houston Natural Gas back in 1985. American Ken Lay was appointed CEO, and legendary artist Paul Rand, who also made the logos for IBM, UPS, and ABC, designed the now infamous Enron E. The energy market underwent significant deregulation throughout the 80s and 90s, leading to extremely volatile prices and a belief that anything was possible as companies rode the bull market that followed 1987's Black Monday. Enron then opened its own trading subsidiary to maximize profitability, and Jeffrey Skilling was appointed CEO of Enron Capital and Trade in 1991. Skilling oversaw the introduction of mark-to-market accounting within the corporation. That is the practice of valuing your assets based on predictions of their future prices rather than on historical prices. And in short, it basically gave Enron the right to decide their own profits without being held accountable for the accuracy of the valuations. Based on these optimistic calculations, Enron's revenue figures began to skyrocket as the 90s wore on. The firm was named as Fortune's best company to work for in 2000, as its stock price peaked at $90 a share, and its directors outlined their expectation of even further profits in the near future. As Enron invested hundreds of millions more into projects both in the US and overseas, the company was able to hide these losses behind false estimations of the new assets' value, like a power plant in the northeast of England. To cover any reported losses or cash flow issues, Enron would borrow money from its SPVs, special purpose vehicles, which were subsidiaries of the corporation capitalized with Enron stock, making it impossible for the lenders to retrieve their money if the energy company was struggling. The crashing of the dot-com bubble in 2000 hit Enron's assets hard, as they had now diversified into industries like video on demand and high-speed broadband networks. Investors were becoming more cautious and increasingly skeptical of the firm's complex business model, and by early 2001, serious questions were being asked of Enron's financial statements. Lay stepped down as CEO in February to be replaced by Skilling, with Enron's stock price halving to $40 in the 6 months that followed. Amid widespread speculation about the company's accounting methods, Skilling stepped down from his new role in August 2001. As Lay returned to his former position, analysts were downgrading Enron's stock rating, and Lay began selling millions of dollars worth of his shares in the firm. In October, Enron announced its first quarterly loss in 4 years, thanks to taking charges of $1 billion from its underperforming assets, and the SEC began a formal investigation into its financial statements. During November, the company revealed it had overstated its profits by $591 million between 1997 and 2000. Meanwhile, over 20...
Okay, so this is 6 minutes long, so that's quite, which we can look around this video, is how the scandal is happened, and Enron, that scandal was the huge, so we can't really 100% rely, as you couple of you watched now, the video which I was showing you, Enron scandal, how this is, the manipulate. So that's we need to be look around when we looking the ratio, definition about the creative accounting, the process of accounting rule, manipulate the figures reported, why creative accounting, earning per shares and all, which is in case of creative accounting due to hide the bad. We have a lot of accounting standards being set up, like IFRS 16, leases, and the leases, the representation and the commitment, how long the lease is. should be clearly represented in should be shown in the financial statement. That's we need to be look around in the light of, and because otherwise it can be huge impact. So creative accounting can play. So in your ratios, we not only look the creative, we have to look around what is happening front environment, what impact we have. We can look around in the light of financial ratios. Yes, ratios is an interpretation. We not 100% realize. We can look around the economic social. So we had a discussion about. So please, we can look around useful link. How we can manipulate and the company. And please, if you want to do the question, more question on the ratios. It's 7.1, 7.7 Osborne handouts, which is available on the Moodle place. Please, before next lesson, if you do some ratios calculation you're in to enhance your understanding about ratios, and then you decide, which company to invest, why we invest. So today lesson, we had a discussion about ratios. So we discussed about liquidity, liquidity ratios. We discuss about profitability ratios. We discuss about use of resources, are also known as efficiency ratios. And we had a discussion about gearing ratios, financial position ratios. Yeah. So these are the ratios on the basis ratio, the relationship between two numbers, and all the formula sheets available if you want to. So you can pick some ratios we can use, and when we'll do the assignment discussion, so we can use these ratios to measure the performance of the company. So anyone, any question before we finish? No, thanks for attending. Those are just listening. Please, if you have any question, drop the email anyam@university.co.uk, and I'll try my best to get back to you as soon as possible. Thanks for attending. Have a lovely weekend. I'll speak to you next week. And thank you. Bye bye.